Good morning, everyone. This is Anna, Jim, and Eric, and our show Live with Main Street. Hi, guys.
Good morning, Anna. Good morning, everyone.
Good morning. How are you doing?
Great.
Good. Well, today we have a special theme for our show, and what we want to talk about, it has to do with risk management for property. And what I've referred to here is homeowners insurance, renters insurance, landlord's insurance, and auto insurance. This is a typical area of expertise for financial planners. And so when clients come to our doors, we review policies and make recommendations. So we thought we could go in details and share some of our insights and what to look for and why do you even need some of these policies. How does that sound?
Perfect.
So let's start with first, homeowners and renters policies. So these types of policies typically cover personal property, right? In case of homeowners, if you own a home, it will cover the actual building or the structure of the home itself. But there's also another part of the policy that provides coverage, and that is frequently referred to as liability protection. So can we talk about this particular coverage? And so how much do we typically need? How do we determine that type of coverage? And if you have some other suggestions about whether the policy, when we're reviewing the policy for a client, whether they have enough or if we can get more and how. So maybe each of you can take a chance to answer the question.
Well, I'll go ahead and start. In our interview or questionnaire, we ask clients, what is the square footage of your property? Because when a claim is made, especially if there's total destruction or major destruction of a property, usually the dwelling coverage is reimbursed on a cost per square foot basis. So we usually look at the dwelling coverage divided by the square footage to see approximately what is that coverage per square foot. And I've learned over the years through painful experience of others, when I lived in Santa Barbara and there was a huge fire that burned 990 homes down, if you didn't have at least 80% coverage for the replacement cost, then the insurance company prorated it. So if you only had a 60% coverage because you didn't want to raise your coverage because the premium would go up, then they only paid you 60% of the cost of rebuilding. But if you had more than 80% coverage, then you were completely reimbursed for reconstructing the home. So that's the first thing I look for is dwelling coverage.
Okay, but in case of renters, so somebody who rents an apartment or even a home, there's no such thing because that's covered under a different type of policy, correct?
Right, so renter's insurance will usually cover your personal property under whatever home you're renting. And then the homeowner will have a homeowner's policy that'll cover the actual physical property itself and any outbuildings.
Right, and that's frequently referred to as landlord's policy. If you rent a property to somebody else, correct, Jim?
Yes, that's correct. And many times it's called a fire policy because it's really just ensuring the rebuilding of the structure, either partial or completely. And many times in our practice, we recommend that landlords require their tenants to have renters insurance to cover the renter's contents and name the landlord not as an other insured because they don't need additional insurance, but as an interested party. So in case the renter dropped their policy, the landlord would be notified. And if that's a criteria for renting from the landlord would contact the renter to reinstate it.
Mm-hmm, mm-hmm. Right. Well, for renters and homeowners, there's another. So we talked about dwelling coverage, actually covering the building, the structures that you live in, and your personal property. But there's also liability portion of each policy. So how do we determine how much liability each of us needs? Because that's the same this is the same sort of maybe rule of thumb for both homeowners and renters policy. Eric?
As a general rule of thumb for me, I like to see all my clients, regardless of their age, have a minimum of $1 million, personal liability as an umbrella. Because that'll protect their future income, it'll protect any assets they happen to inherit, things of that nature. So I mean, as a rule of thumb, I want to see a $1 million umbrella liability policy, and frequently, to get that umbrella, there's going to be minimums that the insurance company wants you to have for your other policies before they'll give you the umbrella. So that's how I determine what the minimums are. Is, do you have an umbrella policy? If you don't, regardless of your, obviously if you're 18 and over, you need something.
And these minimums could be like 100,000. I frequently see 200, maybe 500,000. And then if what Eric is referring to is umbrellas, an additional liability protection that you get on the top of your homeowners or renters policy. And we'll talk about auto in just a few minutes. So we start with just assessing. And what I do when I look at the client's financial balance sheet or financial statement is, what are we trying to protect, right? Obviously, we're trying to protect their assets. And so a rule of thumb for me is to look at what is their net worth, right? You look at their assets, you look at their liabilities, and that's how you determine net worth. So what you're trying to match up is the amount of the liability protection to at least what their net worth is. And a lot of cases in the metro areas where we have our offices, there are folks who are high earners, so their income is a lot higher than their assets. So it may not be always that equation always works right, but at least you assess what their assets that we're trying to protect first, and then you also think, okay, well, so if they're high earners and there's ever a lawsuit against them, then that additional or liability protection plus whatever additional amount we have could provide the coverage. So the income, the earning abilities are also a factor in determining how much each of the clients need. Jim, do you have anything else to add to this?
Yeah, there was a big Supreme Court case in approximately 2006 that reaffirmed that creditors could not attach retirement plans covered under ERISA. Those would be the 401k, 403b, simple IRAs, SEP IRAs. Those are qualified pension plans. However, they left it up to the states to say how much would be exempt from creditors. For example, in California, statutorily, it's only $500,000 in an IRA that's exempt, and then a judge gets to decide if creditors can attach something larger than a $500,000 IRA. So we're looking for protection from creditors. That's getting a judgment against you. Of course, the IRS can always attach anything, so we'll let the government have its day. So we're looking at what assets are exposed to creditors and what income is exposed to creditors too, because there's something called garnishment, where you can get a judgment against someone's future income, and that's paid out as the person earns it. So those are the things we're looking for. And Eric is good to always look for that umbrella liability policy. And I would say the majority of our clients, the middle class, the upper middle class that we're seeing a lot, usually they have an umbrella liability policy just for that reason, because that future income or future inheritances is going to be protected ahead of time.
Right. So an interesting situation, and we can see this a lot too in the millennial generation. Those are the younger generation who are just starting out. A lot of them may be earning good income, but they don't have a lot of assets. So do we recommend an umbrella policy to them as well? Because, let's say they don't own a home and they don't plan to buy a home.
Well, that's why we call it risk management, because we look at the potential risk. If they're driving a car, then that's a potential risk. If they're having a lot of parties in their apartment, that's a potential risk. So it always goes to the individual case rather than just a blanket statement. So I would say the lifestyle and the propensity of the clients to suffer some sort of a tort, that means an action or something that they commit, or someone that's committed on their property, where the victim may look to them for compensation. It's got to be on an individual basis. But I think it's good to be thinking, having an umbrella liability policy, because that'll tell us what the minimums are. And then the client can decide if they need that umbrella coverage or not, but at least we bring it to their attention.
Right, right. Okay, let's talk for just a few minutes about automobile. Most of us have automobiles, or we actually may not own one, but we may be renting an automobile. A lot of times at the rental counter, you're being pitched a policy. So let's talk about just a general auto policy. What does it cover through each section? And what are our recommendations for each? And how do we assess a policy? Who wants, Eric, you want to start?
Sure. So you have, in terms of what it covers, you have collision, and then you have comprehensive. So collision is if you hit another car, and then comprehensive is if you hit anything that's not another car. And then you have, individual liability and uninsured motorists. So those are the things it'll typically cover with regards to the coverages. And then within that, you'll have different coverages. You'll have, let's say, 100,000, 300,000, 50,000 or something. And that's going to be how much per individual will be the first number, per accident will be the second number. And that's what you're going to use to calculate how much you'll get back from the accident.
Mm-hmm. So again, we're circling back to that point about the liability. So now, if you remember, we talked about the homeowners. So when I sit down with the client, what I do is I draw a picture of an umbrella, and I say, okay, on one side you have your automobile policy, and here you have either homeowners or renters, and so the umbrella kind of provides that additional coverage. Now, in the automobile policy, and Eric just mentioned, we have these limits, right? You either do per accident or per person or per accident as an aggregate. Can we dive in a little bit into uninsured and underinsured motorists? Because that is the most overseen coverage in all of the policies that I've seen. So what does it cover, and why do we stress on it so much? So uninsured and underinsured motorists. Jim?
Well, we know from research that a significant number of people are driving without automobile insurance, even though state laws mandate it. And some of them only carry minimal coverage. And what uninsured or underinsured motorist coverage is trying to protect is your valuables, which is your car and your person, and your ability to earn income if you're still working. So if someone has a very low uninsured motorist coverage, many times we recommend to increasing it, because that's where your reimbursement is going to come from. So it's a area where people don't focus on until something bad happens to them, and then it's too late. So as financial planners, we're trying to get out in front of these potential incidents and making sure they have adequate coverage.
Yep, exactly. That's the one. Go ahead.
One more thing to add on that for uninsured, underinsured. If you get hit and somebody doesn't stick around, it's a hit and run. That falls under the uninsured, underinsured. So, that's just to protect yourself. If you're going through an intersection, somebody, hits you and keeps going, or sideswipes you on the highway, you're still covered.
Yep. One of the things we also look at in all of these policies is the deductibles, right? And a lot of times people don't think through whether, they just kind of pick a random number. In the case of auto policy, a lot of times you see $250 or maybe even $500. So we a lot of times we recommend to increase deductibles is if you don't plan to file small claims. So these deductibles refer to, and Eric mentioned, comprehensive and collision coverages. So if you, and especially if you have a new vehicle, the premiums tend to be higher because that vehicle is more expensive, right? It's new. And so how do you sort of balance the premiums with the deductibles? So you increase the deductible, obviously, to a level of your comfort zone. So $1,000 seems to be not a break-even point, but a lot of people can handle $1,000 out of pocket. And that keeps the premiums, especially for new vehicles, a little bit lower. I've seen some policies with $1,500, but no more than that. I don't know about you guys, but I think $1,000 to $1,500 seems like a reasonable out-of-pocket deductible.
Well, Anna, and viewers, it goes back to the original concept of insurance. Insurance is purchased because you can't afford the consequences of a certain event. And so if you can afford the deductible of, say, $1,000 and it reduces your premium, then we as financial planners many times will calculate how many years, say you're going from $500 deductible on your collision to $1,000 deductible, the reduced premium, how long will it be until you've recouped that self-insurance that you just increased by $500? And in my case, and actually it happened right after Anna and I started working 10 years ago, I changed from 500 to 1,000, and it took me about 4.5 years in saved premiums to reach that $500 amount. And so for many of our clients, it's 3 years or 7 years or something. We usually tell clients if it's more than 10 years, well, probably keep it at $500 because it's not really economically feasible. But everybody has got to run the numbers and see, you know, how soon do I get my increased risk back in my pocket?
Yeah, I've had the same experience when I had, my car was not as old as it is now, but same kind of calculation. It was about 4 years. I went from 500 to 1,000, and it saved me like $160 a year. So I figured, yeah, 4 years, I'll be even at that point. I have not had any accidents, so it paid for itself. So I had a schedule. One last question to wrap up. A lot of times we have clients who have policies from different insurance companies. So is there an incentive besides getting a little discount, right, when you aggregate all of your policies from under one insurance company, or do we not agree that we should have all the policies from one insurance company? Eric, objections to that?
I don't have any objections. I mean, I would look at the rating of the company itself, make sure you're with a strong company that's going to be around to pay the claims. But if you're satisfied with the service you're getting and they're going to be around to pay the claims, I personally don't have a bias.
I agree. I advise clients to have everything under one insurance company if possible. But a lot of times, just a couple of days ago, I had a client who said, you know what, it didn't make sense for me to consolidate under one insurance company. I'm going to keep my two separate, homeowners and automobile because it was cheaper in premium. So that was kind of the I guess the question the client was asking. But well, that's all we have as far as our questions go. So the theme of the month, or focus of the month for Main Street, for three of us, is to continue talking on these topics that we covered today. So risk management. We have a few shows coming out, and we're going to be writing articles and blogs. So stay tuned for more interesting information from us. And if there are any more questions that you think we didn't cover, please send them our way. And we'll see you next month. And Jim and Eric, you guys have a great weekend.
Same to